Revenue-sharing agreements form the backbone of many successful business partnerships, determining how income is divided among stakeholders. Without a properly structured agreement, even the most promising business relationships can quickly deteriorate. A revenue-sharing agreement is a formal document that outlines how business income will be distributed among partners or stakeholders. These agreements, sometimes called profit-sharing agreements, establish clear criteria for the distribution of business profits or losses, providing a framework that prevents future disputes. Why are these agreements necessary? Partners in a business need a systematic way to share profits and losses. Without a written agreement detailing how financial benefits and burdens will be allocated, conflicts are almost inevitable. Experienced business owners recognize the importance of having a comprehensive partnership agreement that anticipates various scenarios and clearly explains how profits and losses will be shared in each case. Federal and state laws don't dictate how partnerships must share revenue. Partners have the freedom to establish their own criteria based on their specific business model and relationships. Several common methods exist for sharing profits and losses. Some partnerships base distributions on capital contribution, rewarding those who invested more money when the business was launched. Others use management contribution as the primary factor, giving larger shares to partners who take active management roles, especially in businesses, requiring specialized skills. Many partnerships develop custom criteria where profit shares vary based on business performance or other factors. In some cases, certain partners may be entitled to shares of profits, but protected from losses. A comprehensive revenue-sharing agreement should include several key elements. It must identify all partners by name and address, and be validated with signatures from all parties. The business name and address should be clearly stated, along with details about bank accounts where profits will be deposited and payments made from. The agreement should address how sweat equity payments will be handled, particularly when managing partners draw salaries while inactive partners don't. Profit and loss sharing ratios must be clearly defined, typically as percentages adding up to 100%, ratios or fractions adding up to 1. Examples can help illustrate complex distribution formulas. Restrictions should be included to prevent partners from incurring expenses without proper authorization or misusing company resources. The agreement should also address partnership continuity, explaining what happens to a partner's share if they die or wish to leave the business. Effective revenue-sharing agreements build in flexibility to accommodate evolving business relationships. Consider including performance-based adjustments that allow revenue splits to shift based on achieving sales milestones or expanding into new markets. Tiered models can structure splits that change based on revenue thresholds, such as 20% on the first $100,000, then 30% above that amount. Hybrid approaches might combine revenue and profit sharing for a balanced risk-reward structure, particularly valuable in early-stage ventures. Several legal and financial considerations must be addressed in a well-drafted agreement. Tax implications vary depending on how revenue allocations are classified, whether as income, royalties, or service fees. Intellectual property rights must be clearly defined, establishing who owns the underlying product or content generating the revenue. Industry-specific compliance requirements may govern fee-splitting or shared revenue models, particularly in regulated sectors like healthcare or finance. Termination clauses should outline conditions for ending the agreement and handling outstanding payments. Audit rights allowing partners to inspect financial records promote transparency and trust. Consulting with legal and tax advisors helps prevent future disputes and regulatory issues. It's important to understand the distinction between revenue sharing and profit sharing. Revenue sharing distributes gross income before expenses are deducted, with each party receiving a fixed percentage of total sales. Profit sharing, by contrast, only distributes income after all operating and other expenses have been deducted. For example, in a software-as-a-service revenue-sharing model, a partner might receive 25% of subscription revenue, regardless of profitability. A profit-sharing arrangement would only allocate funds after accounting for costs like hosting, support, and salaries. This distinction becomes particularly important when one party bears significant operating expenses. Revenue-sharing agreements appear across diverse industries. In affiliate marketing, businesses compensate affiliates with typically 10 to 30% of sales they generate. Software as a service companies often use revenue sharing with integration partners or resellers, offering splits from 20 to 50%. Franchising models usually involve franchisees paying franchisors an ongoing fee of 4 to 8% of gross revenue. Licensing arrangements allow companies to receive a percentage of revenue generated from their intellectual property. Media and content platforms like YouTube and Spotify typically follow a 70-30 split in favor of creators. A properly structured revenue-sharing agreement aligns incentives between business partners while providing clear guidelines for financial distributions. By addressing key components, building in flexibility, and considering legal implications, these agreements create the foundation for sustainable business relationships. Whether you're forming a partnership, launching a joint venture, or establishing a licensing arrangement, a well-crafted revenue-sharing agreement protects all parties and sets the stage for mutual success.